Donald Trump over this weekend pretty much confirmed that we're heading into a recession. I do think that is why Bitcoin is selling off over 4% in the last couple of hours, down from about $86,000 down to $82,000 per coin. Donald Trump was asked about the Atlanta Fed warning of an economic contraction in the first quarter of the year. Trump seemingly acknowledged that his plans could affect U.S. growth. Still, he claimed it would ultimately be great for us. Quote, "There is a period of transition because what we're doing is very big." Trump said, "It takes a little time. It takes a little time." Also, could send markets lower in the beginning of the trading week is Trump says, quote, "The tariffs could go up as time goes by, and they may go up. And I don't know if it's predictability," the president said. And Lutnick says, "Will there be distortions? Of course. Foreign goods may get a little bit more expensive, but American goods are going to get cheaper. You're going to help Americans by buying American." That's false. Let me tell you right now. American goods are not going to get cheaper. It's just not going to happen. Honestly, to me, it seems like the administration wants to push us into a recession. Let's think about this logically, okay? If you go into a recession 2 quarters into a new presidency, you could say, oh yeah, that was the last guy that did that. Now, I'm saving the day. I'm going to get us out of this recession. We're going to come out stronger on the other side. It's an easy, story to tell. For better or for worse, whether it's true or not, that's a good story, right? And the administration is literally telling you we're heading into a recession. Scott Bessent said, essentially, we're going into a recession as well. He said the economy is starting to roll over and there's going to be this quote unquote detox period, which is a way of beating around the bush to say recession. Now, in this upcoming week, we are going to have some important economic data: PPI, CPI, Michigan consumer sentiment, job openings, and more. And I will share that with you here in this video. Now, first and foremost, I do want to say I think we're due for some kind of tactical bounce, okay? But here's kind of the problem. I mean, the swings on any given day are massive. So technically, we've already bounced about 1.84% from the low of the day on Friday. So you've already seen a little bit of a bounce, which, it just makes markets confusing, right? Because you've already bounced almost 2%. Now, we are sitting at this 200-day moving average, not too far off of where we are now, and that's a big level that we want to hold. If we don't hold that, then we will fall further in the short term. The next level you could really target is that 555 level, and that would put the peak to trough decline, if we hit that, about 9.5%. And ultimately, I think if we do bounce from here, tactically, investors will sell it. Like, this is not the end of the markets going lower, in my opinion. And if the president's administration is trying to push us into a recession, at the same time, the Fed is not rushing to the markets, help here, that could mean substantially lower prices and levels for markets. And I will explain how I am positioning my portfolio to benefit from this. Because again, if you have a long-term perspective, you can make a lot of money with the information provided to you here in this video. I mean, just imagine it. If you did not invest as well as you wanted to in 2022, if you did not go all in on Meta at $90 or, continue to buy stocks in 2022, if you were scared or concerned, well, now you have potentially another opportunity coming to do just that. And if it is a prolonged period of downside, then you have some time. You have some time to continue to work, to save money, to put money to work in markets. I think one of the worst things that, could happen right now is like a COVID crash, just a panic all at once and then a quick recovery, because you don't have much time to actually position in markets. Whatever you have liquid today is basically whatever you have to invest, right? If we do get downside, I would want to see it a little bit more extended so more people could take advantage of it over a longer time frame. And unfortunately, I do think this is going to be a prolonged process. You don't go into a recession overnight. And I can tell you right now, the administration wants us to go into a recession. They want to reset interest rates. They want to reset inflation so we can get back to having a good market, good economy, 2026, 27, 28. And right now with the S&P down 7% or so from all-time highs, you're not pricing in that recession risk. But as I've talked about before here on this channel, if you look at a stock like Tesla, or you look at other momentum names like Palantir, they are pricing in recession risk. But that has not hit the broader markets yet, and it is only a matter of time. And of course, I don't know if we're heading into a recession as the ultimate destination. But with the administration that I believe wants to push us into a recession or close to one, I think that will get priced in more to markets. And I think that does mean more downside, whether or not we have a recession, a shallow recession, a deep recession, close to recession, kind of recessionary dynamics, but never go into one like 2022. I do not know that ultimate answer, but I do know you probably don't want to fight the administration here because it doesn't look like Trump's going to back down if Q1 GDP is negative. And it looks like Q1 GDP could be negative. And if it is negative, fears of a recession will rise and stock prices will fall. And again, you've already seen the start of that. Now, the SMH, the semiconductor ETF, has been a big leading indicator of this, okay? Normally, you bounce at your 200-day moving average. The last time we were below the 200-day moving average was in January of 2023. So coming out of 2022, you broke above this 200-day moving average, and you never went below it again. You touched it back here in October of 2023. August of 2024, again in September of 2024, and many times since then, you kind of bounced off of the 200-day moving average, even as early as February 25th or 24th, you were above your 200-day moving average. What has happened in the last 2 weeks is a utter collapse of this ETF. This could be a leading indicator, because semiconductors are cyclical in nature. They go through booms and they go through bust. And as the economy weakens, semiconductors do worse. So if you're thinking of a recession, semiconductors would be like up there with autos, and it would be up there with like restaurants. Like these are the last places you want to invest your money during a recession. And it seems like this is a leading indicator of more downside that could be coming from markets. Because again, effectively right now, you have an administration that wants to push us into a recession. The Fed is on the sidelines. They're nervous about inflation. They should really be nervous about the economy. And by the time they get enough confidence to react, it's probably going to be too late. There's probably going to be more weakness and more downside priced into markets. Now, ultimately, like I'm an uber bull, right? At heart, I'm optimistic at heart. Long term, you want to be invested in markets. I think the next 20 years are going to be generational wealth opportunities. Okay, you want to buy when you get deals, and I think some stocks are deals, like Tesla, right? That's a deal right now. I think it's appropriately balanced on a risk-reward basis, right? You're already pricing in some of that recession risk. If we don't have a recession, well, Tesla's a great buy at these prices. The S&P, even if we avoid a recession, you're probably not appropriately priced for recession risk, only down 7%. Again, with the backdrop of the last 2 years being, this good, 7% down in the S&P is not attractive to me whatsoever. Even as Tom Lee said over this weekend on the Compound and Friends podcast. If you have not watched that, I think you should, because he does sound a little more cautious than he normally does on markets. And really why I think we could be heading closer to recession, like, this is not rocket science, okay? Like, I didn't go to college. I've studied economics since I was 18 years old. I've studied markets since I was 18 years old. And, you know, it's pretty obvious to me, right? Besides just, you know, Trump trying to push us into a recession, the Fed's not here to help us. We do have a little bit of an inflation problem. I think that will be going away as the economy gets worse. I don't think tariffs will be inflationary. I think they're just going to be bad for the economy. It's essentially a tax on U.S. companies. Like, what companies are going to do is fire people to make up the difference. If they cannot pass those costs on to consumers without demand destruction, they're going to fire people. And I think that's part of why you've seen the Challenger job cuts come in at 172,000. Like, that is at the peaks of recessions, like 08, 09, 2001, like when shit was hitting the fan is when you had Challenger job cuts look like that. I mean, that's insane, right? And I can actually pull that up for you. I believe I still have it up here in one of my 75 tabs. Yeah, look, I mean, 172,000 is like the peak of the 08, 09 recession, right? There was only 1 month that was higher, and it was January of 2009. It was 241,000. But like March of 2009, what is this? December 2008, like, you were at these levels throughout the 08, 09 recession. Same with 2001, right? You were at these similar levels. That's a pretty damn clear recession signal to me. The Fed is not paying attention whatsoever. You've also had retail sales, personal spending go negative. You've had a lot of really bad leading indicators of the economy. And I think we do push closer to a recession narrative. And as that happens, that's going to put downside pressure on stocks. And I don't think we are pricing in that risk in the broader S&P. Now, here in this upcoming week, starting off tomorrow morning, you will get consumer inflation expectations. You're expecting 1-year inflation expectations at 3.2% coming tomorrow morning. Again, just be mindful of the political affiliation there. Democrats expect a lot of inflation. Republicans expect no inflation. Independents are at like 3%. Right? So just be mindful of that. But that's pretty much all we have for tomorrow. On Tuesday, you have JOLTS job openings. Now, if this thing plummets on Tuesday, that's going to be something to really pay attention to, because, you know, if you're doing good and you're a small business, you're looking to hire 5 employees, that's great. The next month, let's say you're only looking to hire 2 employees, that's a red flag that things could be slowing down broadly. So less job openings, likely weaker the economy. More job openings is a good sign. So that's what we have for Tuesday. That's your big data. Wednesday, you have CPI. You're expecting month over month at 0.3%. This one's pretty, again, self-explanatory. If you have good numbers, good CPI, low CPI, that's good. If you have high CPI, that's bad. But also, like, a too low of a number, like China just had negative inflation over this weekend, negative 0.7% year over year CPI. That's also not going to be a great sign for economic activity. Now, the expectation is 0.3%, so expectations are high, and I think there's a good chance we come in lower than that for the month of February. Year over year is expected at 3.2% to move lower than last month's 3.3% reading. Headline month over month expected at 0.3%. Year over year headline expected at 2.9%. So I think across the board, you could probably come in with lower CPI, and that could help give us a little bit of a bounce. Okay. Would not surprise me at all if CPI is lower and markets react favorably to that. Now, if it comes in high, then you're looking at stagflation, and that's obviously not good. On Thursday, you will get PPI month over month and initial jobless claims. Lots of smaller data comes out as well. PPI excluding food, energy, and trade month over month. A lot of smaller data points as well. 30-year bond auction. as well on Thursday. On Friday, you're going to get the Michigan Consumer Sentiment Survey, expecting the headline number to fall from 64.7 last month down to 64. What has caught people's attention recently is the rise in 5-year inflation expectations and 1-year inflation expectations. But this survey is very political. Again, Democrats expect almost hyperinflation. 7% of respondents to this survey think we're at inflation levels over 25%. Like, there's a huge political element to the survey. But last month, you've seen a big rise, highest levels of 5-year inflation expectations since 1995. And you're expecting that's going to move higher from 3.5% to 3.6%. So that is a little problematic if that happens again. Consumer expectations are expected to fall as well. Current conditions also expected to fall. And 1-year inflation expectations expected to rise from 4.3% to 4.4%. And I think that is going to be something the markets pay a lot of attention to, because that rise in 5-year inflation expectations and 1-year inflation expectations did spook the markets last month. Now, we do still have a lot of earnings that are still going to be coming out this week, Monday and after hours. So tomorrow and after hours, you have Oracle and Asana, as well as Vail Resorts and some others. Tuesday pre-market, Kohl's, Dick's Sporting Goods, Ferguson. Tuesday and after hours, Casey's and some other names. Wednesday pre-market, you have Zim, iRobot, some other names. Wednesday and after hours, Adobe, UiPath, Centennial One, American Eagle Outfitters, some smaller companies as well. Thursday, you have Dollar General, Futu. Thursday and after hours, you have DocuSign, Ulta, Semtech, and then Friday, a couple of other names. There's a lot of smaller cap companies that are still going to be reporting this week and even over the next couple of weeks. But some big ones like Dollar General, Ulta, DocuSign, Adobe, UiPath for what it's worth, Oracle, Asana, right, Dick's Sporting Goods. These are going to be companies that Wall Street pays attention to, especially some of your retailers like Dollar General. I think is going to be really important to see, are consumers continuing to spend money? Ulta, same thing there. Could they be vulnerable for a consumer that is slowing down? Potentially. And that's something Wall Street's going to pay attention to. Now, the CNN Fear and Greed Index today is at 20, which is a little bit better than where it was previously at 17. And overall, I think you could be due for a bounce in markets, a further bounce in markets. But I think it will be sold off as the economy continues to look like it's heading closer to a recession. The percent of stocks trading above their 50-day moving average is at 31.35. So you're still very bearish from that measure as well. And bullish investors are at lows we have not seen in many years, coming in at 19.3% of investors that are bullish, 23.6% that are neutral, and 57.1% that are bearish. So like the last 2 weeks, sentiment is absolutely terrible. So let me know what you guys think about this down below in the comment section. What are your thoughts about this upcoming week? Let me know. Because, maybe I'm wrong. Maybe this is, going to lead to new highs soon or something. Maybe we're not heading towards a recession. But to me, I don't like the risk reward. There's always the potential chance that markets get back to business as usual. But unless Trump drops the tariffs, and makes it clear he doesn't want a recession, I'm not confident buying the headline S&P at these levels. I don't think that is sufficient to price in recession risk. And I think that's ultimately what Trump is trying to do, is to cause a recession, blame it on the Biden administration, and kind of reset interest rates, reset things, which, that might be the way to go. That might be the best thing to do, right? Instead of taking years to get potentially inflation down and this slow grind, just front load it, right? Cause a recession. And I think it's Doge affecting confidence. People are not spending as much money. I think it's the tariffs and business leaders that are really hesitant to invest or especially hire new people. That is all coming together right now as a catalyst for this potential recession. Again, I don't know if we're going to have a recession, but I think we're going to head closer to that. And the Fed, they're not in a rush to accommodate markets, and that's the other side of the problem. So let me know, again, your thoughts on this down below in the comment section. How are you investing your portfolio? I'm looking at TLT calls right now. I'm looking at puts on the SPY. If we do go through a little bit of a bounce, in which I wouldn't be surprised if that happens this week. That's kind of my game plan going forward. And then to buy some of the quality beaten down names like Tesla here, I think is a pretty good buy. And raising as much cash as possible. Anything that, I absolutely would not want to own in a recession is gone. Okay. If there's like bankruptcy risk, if we were to go into a recession, it's gone. Okay. Again, just how I'm investing. Let me know how you're investing down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.